Matthew Sherwood is Head of Investment Strategy, Multi-Assets at Perpetual Investments, joining us from Sydney. And Matthew, what do you think's happening here? Is this raging mania, as some have described, or does this buy the dip mentality make sense?
I think it's just a bit of LBS, liquidity-based speculation. So valuations become very, very frothy, and it's good to see that a little bit of that froth has dissipated, but there's still a lake full there, and so I don't think this is quite a buy the dip moment. It is still well and alive. The concept in markets, there's a hell of a lot of liquidity sitting on the sidelines that can be deployed. I don't think a 10% dip in these tech stocks, which have had rallied 96% from their March base, is necessarily a trigger to be going into them at the moment. But as I said, there's a lot of cash on the sidelines, and people are thinking a 10% correction. That's when I buy, and that's what we saw this week.
I think it's fascinating as well, because what this also shows is that equity markets, currencies, commodities are all still volatile. Risk premiums across Asia have increased for most markets. At the same time, economic conditions look really weak. Investor sentiment still pretty soft. What do you think the next catalyst for a move higher is going to be here?
Well, I think the move high is probably going to come in 2021. So I think that, if we're going to get something earlier, then it would have to be some kind of vaccine breakthrough with the COVID-19 condition. Now, we saw one of the leading candidates this week actually pause their entire trial because people were getting some negative reactions to the drug. So I think that's probably been delayed into next year. In the meantime, I think we're going to get a big September quarter growth rates, both in the US and in Europe, but they're going to fade pretty quickly. And at the same time, we're going to have some fiscal drag and some fiscal pullbacks because unemployment's coming down, growth's going up. So I tend to think the politicians will have a natural inkling to pull the stimulus. And of course, after that, we've got the US election and a pretty large fiscal cliff, and that's likely to be contested, the election. So to me, those sorts of factors are all suggesting downside risks at this stage. The vaccine's an obvious upside risk, but I think that's a 2021 story if it's going to come at all.
Which region provides the best value now? Surely not the United States.
No, well, Matt, when you look at each region, you can sit there and say, okay, well, it's got a growth problem, it's got COVID conditions, or it's got elevated valuations. So, central banks have been very central to this rally, but it's created all kinds of distortions, as we know, on both the valuations point of view, are markets properly pricing risk premia? So if I was to look anywhere, when you look at the broader growth dynamics at play within the global economy, clearly China's doing best. They've engineered a complete recovery in their economy. But really, I don't at the moment have any kind of favourite regional tilts, because I think all regions, whether it be the US or Europe or China, are all going to suffer fiscal pullbacks to a pretty serious degree. And I do believe markets are quite mispriced at the moment because, everything seems so artificial with the central banks right in the central of this market rally. And engineering an asset bubble during a recession is something that's never been heard of. And I don't think a 10% pullback in tech shares is necessarily meaning that we're at the end of this process. I think this is probably going to go on for the rest of the year. So at the moment, I don't really have any favoured regional tilts. I'm just trying to get in as much diversification into the portfolio as we can.
What about the credit side of the equation?
Yeah, well, that's another risk that market that you can purchase. The trouble, of course, with credit markets is the recovery from the spread blowouts, for example, in investment grade universe, is about 90%. So it's recovered nearly all of its lost ground. In high yield, it's about 80. And so I would argue, particularly in the high yield market, that I don't think the market's priced for the default cycle, which is ahead of us, and also it's certainly not priced for the massive build-up that we have seen in corporate leverage over the past 7.5 years. So there used to be a lovely correlation between operational leverage to, net debt to operational cash flow and the spreads, for example, in the high yield universe. That, of course, has completely dissipated during the last 7.5 years. The leverage has more than doubled. whereas the spread you're getting in compensation for that leverage build-up has actually fallen. So I don't see much value either in the credit markets at this stage. The best you can hope for in the investment grade space is the running yield. And in high yield, I think is going to be a source of pretty heightened volatility because it doesn't have the Fed backstops in there like a lot of the market believes it does.
Right. Matthew, we're tracking into the European Open now. Interestingly, one key risk event is, of course, going to be the ECB. What do you think the ECB is going to say about the pop that we've seen in the euro and the impact that that's having on inflation?
Yeah, I think they're probably going to be the two key things that they do focus on. I don't think they're going to go down the Fed path of doing major changes to their operating framework. So they'll be clearly worried about the inflation outlook. So, you know, their last updates we got suggest there's not going to be an inflation recovery back to the 2% target for many, many years. And of course, the rising euro has thrown another spanner in the works there, not only from an inflation perspective, but also from a from a risk perspective, a growth perspective. But probably what they may do is try to lay some groundworks for increasing their asset purchases later this year. I don't think they will do it immediately. But in the end, I think central banks really now haven't been able to come up with any credible plan to deal with the effective zero bound of their policy interest rates. And as such, all they're really willing to do is do QE programs to try to get the exchange rate lower. But the trouble with that is everybody else is doing it also. And so when the ECB started their QE program back when Mario Draghi was in charge in 2015, no one else was doing QE, so you got a depreciation of the euro. But I don't think they're probably able to do that this time around. So I think the ECB is finding out very quickly that it's almost at the end of its policy tools where it can get major recalibrations within the economy and also within the markets.